Welcome to The Explainer. Today, we're jumping into a pretty sophisticated investment product, one that's designed to win whether the market's going up or down. It's called a long-short fund, and we're going to use the Sapphire Equity Long-Short SIF to figure out exactly what that means.
Okay, so the very first thing you see when you look at the official documents for this fund is this risk meter. And notice something? It is cranked all the way to 5, the absolute highest level. That right there tells you this is not your average everyday investment. So what exactly makes this fund such a high wire act? Let's find out. To really get why that risk level is so high, we've got to peel back the layers. First, we'll figure out what a long-short fund even is. Then we'll look at its main goal. After that, we'll dive into its unique two-part strategy, see what's actually in the portfolio, and then finally, we'll circle back to why that risk meter is flashing bright red. All right, let's start at square one. This is not a typical fund where you just buy stocks and cross your fingers hoping they go up. The name itself, long-short, is a huge clue that it's playing a totally different game. So what in the world does it mean to be both long and short?
It's actually pretty straightforward. A long position is what most of us already do. You buy a stock and you're betting its price will rise. Simple. A short position is the complete opposite. You're actually betting that a stock's price is going to fall. This fund, it's built to do both of those things at the very same time. And you should know, this isn't a standard fund you can just buy into with a few bucks. It's a specialized investment fund, or a SIF. Now, that's just fancy financial speak for a product aimed at what the industry calls informed investors. We're talking about people with serious capital, who can not only understand, but more importantly, can handle really complex, high-risk strategies.
So why bother with all this complexity? Why buy some stocks while you're actively betting against others? Well, it's all for one very specific, very elusive prize in the investment world. It's something called alpha.
And there it is, right from the horse's mouth. Alpha is kind of the holy grail for a lot of fund managers. To put it simply, it's the ability to make money that doesn't depend on which way the overall market is heading. The goal here is to make money based on sheer skill in picking stocks, whether the market is having a great year or a terrible one. So how does this fund actually go about chasing that alpha? This is where it gets really cool. The whole strategy is based on a two-layered approach. Just think of it as having two different brains that work together on every single investment decision. So the first brain is the big picture brain. It's like the team strategist. It takes a top-down look at the whole economy to decide on the overall game plan. How much risk to take on and what the mix of long and short bets should be. But that second brain, the details brain, well, that's where the secret sauce is. It's a special quantitative model that does the hard, bottom-up work of picking the exact stocks to buy and the exact stocks to bet against. And this right here, this is the engine room of that details brain. It's not just making wild guesses. It's a system, a model that crunches the numbers on companies across 5 key areas. It's looking for quality, like solid financials, and innovation, to find winners to go long on. And at the same time, it's on the hunt for losers, looking for stocks with bad market sentiment, or maybe they look overvalued, or have weird warning signs in data from alternatives like options. It's the super disciplined process that's behind every single trade. Okay, so we've got the big picture strategy and the nitty-gritty stock picking model. But what does all of that actually look like when it's put together in a real portfolio? Let's pop the hood and take a look. This chart gives you a general idea of the mix. See, the fund has a ton of flexibility to shift things around based on what the market is doing. The biggest chunk is in those long equity positions, but a pretty big slice can be used for short bets and other things like debt. That ability to adapt, guided by that big picture brain we talked about, is totally central to the whole strategy. Now, you might be wondering, how do you bet against a stock? Well, you use these complex financial tools called derivatives. They're basically contracts that get their value from something else, like a stock. Using these tools plus a model that is constantly crunching new data means the fund is trading a lot. This high turnover is part of the strategy, but it's important to remember it can also mean higher transaction costs. And all of that, the complexity, the derivatives, the short selling, it brings us right back to where we started, that bright red, maxed out risk meter. It's time to read the fine print. So the strategy is shooting for high returns, but the risks are right up there with it. First up is leverage. That's using borrowed money to invest. It can juice your gains, sure, but it will also magnify your losses just as much. But the biggest danger here, by far, is with short selling. Just think about it. If you buy a stock for $10, the absolute most you can lose is $10. But if you short a stock at $10 and it suddenly shoots up to 100 or 200, well, your potential loss is, in theory, unlimited. On top of all that, you're making a huge bet that the fund manager's models and skills are going to be right time and time again.
And that really leaves us with one final thought. The Sapphire Long Short Fund is, no doubt, a powerful and really sophisticated tool. It's built to hunt for returns in places traditional funds can't even look. But all that complexity and all those high-risk techniques, well, they demand that you have a crystal clear understanding of the very high-stakes game you're choosing to play.